Hey guys, welcome to another Trade Genius podcast. I got my good friend Bob Kudla here, and today we're going to take a look at bank lending and why that matters. We're going to show you where it's at and what it means.
Trade Genius.
All right, Bob. So, net liquidity has been going down. Our net liquidity model has been showing a decline, and it hasn't been following the typical seasonality of Q4. Q4, we usually see liquidity go up. That's been the case the last couple of years, which also is kind of divergent from what we're seeing in the stock market, with the stock market grinding higher. But you pointed out something interesting here. We're going to show a chart in a second about bank lending that go along with that.
Yeah, I mean, look, everything is tied to the money supply, right? So, we're seeing global liquidity fall off a cliff here. Usually the stock market follows 90 days out. I think there are 30 days to go before that plays catch up. But what caught my attention was that, how they push money into the system is that the government overspends. So treasuries provide, excess monetary supply. But bank lending is the other source of monetary supply. And it's fallen below inflation. I know this might be a bit of an eye chart, but bank credit is falling, and also the what I would call the private, the shadow banking systems are falling too, Phil. And so there's this general pullback in lending, and we're coming into an environment where Trump also wants to curtail, lending and borrowing from the federal government. So we're setting ourselves up here for I would say, a deflationary impulse. And the thing about deflationary impulses, they're harder to fix sometimes than inflationary impulses, because not everybody agrees on the solution, of throwing money. And with this administration coming in, that's the last thing they want to do. So this could be the catalyst that we've been looking for that's going to drive the markets down. The other thing that's interesting to me is that although S&P 500 has been kind of grinding up, but albeit very slowly, tech is kind of falling apart under the covers here. And you guys got to keep an eye on that, because at some point that's going to overwhelm the indexes. And I think we're setting ourselves up for, I'm more convinced now that maybe the blow-off rally has already occurred. I know you and I may not be in agreement with that, but our expectation was to have a little bit more positive momentum here going into Christmas than we're seeing generally across the board. And what really was weird today is gold really popped today too, and that's becoming a bit of a safe haven. And so I don't know if the geopolitics are starting to play a role here, or just general exhaustion. The employment report on Friday wasn't anything to write home about. So I just think, guys, abundance of caution, in my view. If you're looking for an easy payday here, we may or may not get it the next couple of weeks, but I would definitely be looking to selling into any strength if we get it.
Yeah, and if you want to flip over to the liquidity chart, right? So this is our net liquidity model, which you guys can actually get. If you go over to tradegenius.co, you can get the net liquidity package. And what it's showing you here in blue is the net liquidity. And what I've highlighted is the last two fourth quarters and our fourth quarter here. So you'll notice the last couple fourth quarters, we typically start getting a build. Now we're getting into the tail end of the Q4 here, right? In December. By now, we should have seen a pretty good sized build, and we have not seen that. And yet the market is still behaving like we are building. So we're getting a divergence here. We've shown you guys a divergence with the job opening chart, right? And so to me, it's like this is again confirming that you are getting a blow off type move. So that's why I'm kind of in the camp that we still got more to go to the upside, right? Because these markets can be, you would say this is kind of an irrational move. And, irrational moves tend to last longer than you think. So that's my only thing. But I mean, hey, we're up at, we tagged 6,100. That was, 6,100 and 6,400 plus were a couple of levels I was looking at for potential top. So we've definitely checked that box. So I'm not totally opposed. I just think that for me, like if I saw a weekly engulfing candle, Bob, bearish engulfing, then I would be like, okay, we potentially have a huge market top here. We don't have that. I don't think we're going to get that this week. And we also have the next week, which is seasonally pretty bullish. So we'll see what happens. But, until I see something a little more bearish, I'm going to be open-minded about where this is going. But I do think that, given what net liquidity is doing, what bank lending is doing, I think ultimately this is the plan from the central bank to kind of rein in inflation. I think they want a little round of deflation. They can't ever say that because the markets will freak out. But I think ultimately that's what they're shooting for, is a little bit of deflation. And with that and the amount of cuts that they have they have a lot of runway for cuts if we get into a recession type environment. Because I think at the end of the day, they know that the constituents, the lawmakers, they're all going to be clamoring for another round of QE. And so they've got to get us to a point where core PCE is back in the box, and we're not dealing with too much inflation, because they will, the minute that that's out of the way, make no mistake, they're going to print. And then you're going to see a really strong reaction, I think, from the market at that point, because we should be at pretty depressed levels from then. I've even looked at this, Bob, in terms of potentially seeing a bear market go well into 2026, looking at some of kind of the larger wave structures of the market. You could convince me that maybe we don't bottom out till Q4 of 2026.
Yeah. I'm just trying to point out to you that the underneath surface is not conducive to what's happening. And I agree with you, markets can be irrational. The chart we're going to show you tomorrow is one of the reasons why it can be irrational. But when that chart we'll show you tomorrow, when that chart breaks, then, good night, nurse,
Right.
because the leverage is just overwhelming. I mean, look how hard it is today. The market's kind of down a little bit, but we can't really find any stocks to buy, which is, I think, is what's really going to freak people out. And that we've had it so easy just finding trades that you get a 25-point down move in the S&P 500s and nothing is showing a buy signal, which is kind of really wild to me. That's what makes me worried that, that I think we're going to get an impulse before we get a rotation. But gold is up today, so maybe it's just a rotation. But I'm worried. I just see all the stool legs getting kicked here, and you can call me bearish Bob, but I'm not telling you the market, but I'm telling you that, cash is okay too.
Hey, look, I think we're close enough, whether it's this month or next month or, in the next week or so, whatever. We've been saying that, hey, don't worry about timing the absolute tippy top of the market. And even when it rolls over, you're going to have a lot of opportunities to get hedged to the other way. So, it's just more about kind of like in crayons, we're getting there. We're getting toward the top. So let us know your guys' thoughts in the comments below. As always, check out our stuff over at tradegenius.co. I think we're going to be in a very dicey environment as we head into January and the inauguration and post-inauguration. And this economy is going to have to deal with some different dynamics at that point. So definitely stay on your toes, and we'd love to help you do so. Thanks, Bob. We'll see you guys on the next video. Take care.
Trade Genius.